Markets are green, oil is above $90, gold is rising, and bond yields are climbing. That is not one coherent risk-on signal. It is a split market pricing two incompatible regimes at the same time. The first regime is the AI rebound. On Monday, the S&P 500, Dow and Nasdaq all closed lower. One session later, semiconductor strength reversed the tone. Across Asia, the Nikkei rose 3.26%. South Korea's Kospi 3.56%, and Shanghai 1.79%. In early U.S. trade, the Nasdaq gained more than 1%, and the S&P 500 roughly 0.6%. But this was not a uniform global expansion. Hong Kong was almost flat. India slipped and Australia barely moved. Capital is concentrating in the most liquid, earnings-sensitive growth assets after a violent technology sell-off. The second regime is the geopolitical inflation hedge. Brent crude moved back above $91, WTI above 85, gold rose more than 1%, and silver 3.5%. These assets are not expressing confidence in smooth, low-inflation growth. They are pricing supply disruption, currency protection, and the possibility that energy inflation stays embedded. The contradiction becomes visible in bonds. The U.S. 10-year Treasury is near 4.60%, Germany's 10-year Bund near 3.17%, and Italy's BTP close to 4%. If this were a clean disinflationary risk-on move, yields would normally fall as growth stocks rallied. Instead, technology is rising while discount rates remain elevated. Why can both happen? Because the market is separating momentum from macro conditions. AI leaders can rally on earnings expectations, data center spending, semiconductor demand, and short covering even while the broader cost of capital remains restrictive. Oil works through the opposite channel. Higher crude raises inflation expectations, reduces the room for central bank easing, lifts nominal yields, and lowers the present value of distant cash flows. The same shock that supports energy producers can eventually undermine richly valued growth stocks. Gold adds another layer. Normally, rising real yields are a headwind for a non-yielding asset. Yet gold is advancing alongside Treasury yields. That suggests investors are not buying a simple rate cut story. They are also paying for geopolitical insurance and protection against a policy mistake. Europe shows the pressured middle of the barbell. The DAX and FTSE 100 are moderately higher. The CAC is almost flat. And the Euro Stoxx 50 is positive but far less explosive than Asian technology. At the same time, Euro area banks report tighter credit standards because of geopolitical and energy risk. The European Central Bank meets this week with markets focused not only on the current rate, but on whether persistent energy pressure changes the next move. That matters because the weakest part of this market may not be the headline index. It is the capital-intensive, leveraged, rate-sensitive middle. Smaller companies, housing, discretionary demand, and businesses that need refinancing. Their problem is not a lack of narrative. It is the price and availability of capital. Currencies confirm that this is not a disorderly collapse in confidence. EUR/USD remains around 1.14, while the euro is broadly stable against the franc, pound, and yen. Stress is appearing more clearly in commodities, sovereign yields, lending standards, and sector dispersion than in a major foreign exchange break. This creates two scenario branches. If diplomacy reduces supply risk and Brent falls sustainably below $90, yields can ease, the AI rebound can broaden, and cyclicals may catch up. But if crude remains above 90 or shipping disruption worsens, the inflation channel dominates. Yields remain high, credit tightens further, and the equity rally becomes narrower and more fragile. The key signal is therefore not whether the index is green. It is whether leadership broadens while oil and yields fall together. Until that happens, this is not one bull market. It is a barbell. AI momentum on one side, geopolitical hedges on the other, and a pressured middle paying the cost of capital. Information is abundant, structure is rare,